Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Lyn Alden. Lyn is a macroeconomist and investment strategist and the founder of Lyn Alden Investment Strategy. Lyn, it's great to see you again.
Thanks for having me back.
Absolutely. The Federal Reserve keeps threatening to hike above neutral rates. Will they try to keep tightening until something forces them otherwise?
That's my base case. Yeah, basically, they have a clear set of mandates, which is, price stability that they define as 2%, the way they measure it for what that's worth, and then also, maximum employment. And right now, with official unemployment pretty low and the official CPI and PCE pretty high, they have a clear credibility problem, and so they're going to try to tighten until something breaks. It's funny if you phrase it a certain way. I mean, basically, when unemployment's low, their mandate is to increase unemployment, and when inflation is below their target, their mandate is to devalue currency faster. It's
Yeah.
kind of funny when you phrase it like that, but basically, they're clearly in right now the mode where they want to increase unemployment in order to take some slack out of the demand side because they can't do much about the supply side. They have no they don't the Federal Reserve doesn't have stockpiles of oil and chips and logistics and copper and things like that. And so the best they can do is try to rein in demand around the margins.
So do you think it's a political pressure right now? Right now, the political pressure is all 100% on, reining inflation. And at some point, as the numbers get progressively worse, whether it's mortgage refis or the housing market or anything, does the political pressure then shift to save the economy at some point and then ignore inflation? Or do they have to go the Paul Volcker route of we've got to stop inflation no matter what?
I think the former. I think they're going to basically shift focus, right? So right now, people, if they want a job, it's fairly straightforward to get a job, and the clear problem that people are facing is inflation. That's what if you poll Americans, what's the biggest concern? Inflation is near the top of the list, and so they have a pretty clear mandate to fight that. I think it's like a dog chasing a car, though. They don't know what to do once they catch it, right? So if you increase, if you reduce demand, that's another way of saying a recession, at least a mild recession.
Yeah.
And so to the extent that they succeed in taming prices, that's not popular either. That's why there's something called the misery index, which is basically the combination of unemployment and inflation. And so you're basically, I think, just shifting from one side to the other side, because the ultimate problem is the supply side, right? So we've kind of have malinvestment and underinvestment in a number of areas. And so until we get more energy supply online, until we get logistics sorted out, you're kind of stuck between, you know, inflation or stagflation, right? So you can print a lot of money and give it to people, but that'll, you'll get currency devaluation, or you can try to tighten demand, but then you get a recession, because the supply side's still tight. And so, as soon as they start stimulating again, I think you're going to, you'd come out of this, if they manage to plateau prices for a period of time due to sinking demand, as soon as they're forced to re-stimulate, I think you'd see, another round of price increases and currency devaluation. What makes it different from the 1970s Volcker era is that debt as a percentage of GDP is so high that, we've kind of extended this for so many decades that there's not a lot of leeway left. They're kind of stuck between currency devaluation or kind of economic collapse or kind of deflationary collapse until we see what's on the other side.
Do a lot of we're obviously Wall Street Silver and we care about silver and gold markets here. And a lot of our people, our audience is waiting for that pivot. We think that as soon as the Fed makes that pause in raising interest rates and maybe pivots back to lower rates, that might be the trigger for gold and silver to finally launch to new all-time highs. Have you given any thought to that, or in terms of what might be the next trigger for the gold and silver markets?
I think so. I think basically we've been in this environment of, at least relatively speaking, a strong dollar. The market, the funny thing is the Federal Reserve has lost a lot of credibility, but the market still seemed to think they're going to keep tightening policy. I think a lot of economists and banks and analysts and things like that, their models only go back a few decades. And so they say, look, there's inflation. They have to tighten until there's not inflation anymore. So of course they're going to do that. Whereas they don't look back further to the last time sovereign debts and overall debt as a percentage of GDP, public and private, were this high, and they don't run the math on, what is positive real rates mean when debt levels are this high. And so I think that, the Fed's going to tighten until something breaks, but their ability to quote unquote normalize rates, meaning get back to a period of structurally positive real rates, is almost impossible. And I think that when they are, they're unable to keep tightening into a weakening economy, and the market realizes that, I do think that hard assets are going to have a bid, and especially, ones whose margins are not threatened, right? So in equities, the problem is you have margin pressure. Stagflation environments are not great for many types of stocks because they have margin pressure, whereas gold and silver, they don't have profit margins, right? They're scarce stores of value. And so that's the type of environment, a stagflation environment is where you generally get the biggest gap in terms of performance between those store of value assets and something that actually has a profit margin. And then you can also lump in things like, commodities producers and certain other types of harder assets in the mix of things that I think would do pretty well if they're forced to back off tightening in response to a weakening economy.
Yeah, do you have any sort of predictions that you're making for your subscribers about how many more rate hikes are likely before we go off the rails here?
So I'm looking more at what to watch rather than exactly where it breaks. And so I think what to watch is treasury market and credit market. So a lot of people, they ask the question, how much further down does the S&P 500 have to go before they pivot? And I think that's the wrong question. I think it's what happens with various types of bond markets, especially treasury and credit markets, as well as repo. But I think that's not going to be the issue this time. Basically, all those different financial plumbing things, if you get a freeze in those, they're basically forced to step back, or if you get a prolonged recession. And so currently I'm looking around the end of the year as the time when they might have to either pause or pivot. I know there's some analysts that are predicting even sooner than that, which would not surprise me. I try to, in general, have conservative estimates. And so I think they're going to push as far as they can. And so right now I'm kind of looking at towards the, by the end of the year, I'd be surprised if they're still able to continue hiking into 2023.
What would be like a key threshold, you think, where some economic indicator, would it be like the market having a 20% down day or something really extreme happening that you would think would just change everyone's calculations on what the Fed's policy should be? Would it be like I don't know, some key economic number just being absurdly bad?
I think if you were to start to see persistent increases in unemployment and initial jobless claims, I think those would. If you describe what you just had, if you get what you just described, like a big down day in the market, I think it's one of those things where that would be coincident with something that would freak them out, right? And so,
Yeah.
for example, I think a down move in stocks itself is not sufficient, but if you had an unusually big down gap in stocks, you almost certainly would have problems in credit markets as well. And I think that would be, spreads blowing out, or back in say late 2018, the Powell pivot, everyone looks at the 20% down in the S&P 500, whereas I think the bigger story underneath the surface is that no junk bonds were issued in 6 weeks in the U.S. It's just like the market was closed, and so I think those are the types of things to focus on. But of course, that doesn't happen in a vacuum. The thing we would see when we turn on CNBC or when we look at dashboards, we would see dislocated markets most likely if you start to see freezing credit markets.
Lyn, looking at the current inflationary pressures and looking back at history, which decades are instructive for you to compare?
So I've been using the 1940s as the closest comparison because I think that's the closest one with the underlying reasoning. So most people look at the 70s as the classic, quote unquote inflationary decade, but I think a lot of the dynamics were different then. So in the 70s, you had baby boomers all entering starting to enter the home buying years. And so you had an increase in bank lending. Basically, you had very demand driven money creation. But that was combined, of course, with guns and butter programs, right? So the fiscal element was an addition to it, but a lot of the money creation was actually private money creation, bank loans. And then you combine that, of course, with the fact that U.S. energy production, oil production, peaked in 1970. And so you had the supply side. I think that's where the 70s are the closest, is the energy side. But I think when you get away from the energy side and you look at the dynamics of why money's expanding, the 70s is not very instructive. If you go back further to the 40s, that's the last time sovereign debt was this high. That's the last time you had you were a decade after a collapsing private debt bubble. Of course, the 1929 crash in the 30s. And the analogy that I've been using is that the 2010s are a lot like the 1930s. It was a kind of the aftermath of a private debt bubble collapse. You had this kind of stagnating environment, rising populism.
Hmm.
And then in the 1940s and the 2020s, I'm using a similar comparison because 1940s, you had, that rising populism led to war tensions, obviously. And then you had that external catalyst. And so the federal government just did absolutely massive war spending, which essentially was fiscal stimulus because they weren't spending most of that overseas. They were spending that on factories and spending that on getting, soldiers to go fight.
Hmm.
And when they came back, they did GI Bills and things like that. So it was actually this huge ramp up in fiscal activity. And that was, of course, very inflationary. And so here we had this kind of rising populism, rising wealth divide. We get hit with the pandemic. They lock down. Then they have to do huge stimulus to pay people who are locked down. And so you had this, it looks like wartime finance. A lot of the charts are the same. And now, of course, we have actual war, right? So I was already making this comparison before we had war. Now we have actual war. That makes sense after a decade of kind of populism. And so I think the 40s are the closest because the inflation, the currency expansion that's happening is not because banks are lending wildly, not because we have a demographics boom, it's because of the fiscal side. And so the causes and the reasons and kind of the limiting factors are the same. In addition to the 40s, because debt was so high, when they had high inflation, they couldn't raise rates very high. They just held rates, short-term rates were near zero. Long-term rates, they actually pegged them, what Japan is doing now, yield curve control. They pegged them at 2.5%, even though inflation hit a year-over-year figure of 19% at one point in the 40s. And so I think in most areas, the 1940s are the most instructive, other than maybe the energy side, which is looking more like the 70s.
Is there a way out of this, really? I mean, we always talk about the Fed being trapped, and there's really no good choices here for them. Do you see it the same way? There's just too much debt in the system. We just have to have a major economic event here to reset.
I think so. I think that when you have, for decades, if your entire system is built on credit expansion, so rising debt relative to GDP, that only works as long as interest rates are structurally decreasing, right? So we kept having higher and higher debt levels relative to our economic activity, but it was offset by the fact that interest rates were going lower. And so our interest expense was not really increasing as a share of income, as a share of GDP. And the problem is when you run into the zero bound, or even in Europe's case, like mildly negative, when you run into roughly zero, if you get increases in debt levels, you get increases in interest expense. If you're getting any sort of positive figure there. And then you also have that much debt in the system, and then you run into a commodity bull cycle, right? So commodity capex tends to go in these big kind of decade-long cycles. And so the 2010s, we had this period of especially the second half of it, we had this period of oversupply. And so you could get away with a lot of money printing and kind of low interest rates, negative real rates. But when you have commodity shortages and you have debt levels that high, I think that's where things hit the fan. And so I don't really see them having a way out of this other than, having an inflationary period that could wipe out, if it gets bad enough, that can wipe out enough debts that they're then able to normalize. But of course, that's after cash and bondholders have been eviscerated. And you probably had multiple political changes along the way because people be so frustrated the whole time. Then you could potentially normalize. And I think that's one case. We've never gone through this environment in a purely fiat system, right? So there's not even, we're not sure that they'd be able to even stabilize after that. It's a possibility. I think that we'd have to get more clarity by that point. But I don't really see a way out when debt levels are this high until you have a lot of debt destruction, which is not going to happen in environments, in countries where they can print money, they always choose to print money. So in emerging markets where they have a lot of debt that they can't print because it's in dollars, they actually default. Whereas if the debts are denominated in dollars and euros and yen in the United States, Europe, and Japan, they just print the difference. And so I think we're gonna, the only quote unquote way out is inflate the debt away. Nominal GDP is way higher than interest rates for a number of years until debt to GDP is lower, everyone's miserable, then they stabilize, and we see what happens from there. I think there's no, I certainly wouldn't want to be in any of these positions because I wouldn't have any answers either. I think the solutions were all decades ago, and now it's just kind of paying the price for those.
Do you give advice to your subscribers or your audience as to where they should be positioning themselves right now for this crisis or what's coming?
Yeah, I make a number I do analysis on different types of asset classes or individual securities. I also provide model portfolios and I share what I'm doing. And so I'm tilted towards hard assets and value. So I like energy pipelines, I like healthcare stocks, kind of that dividend type of stock in general. There are select technology companies that I like, but they're generally a smaller percentage of the portfolio. I'm invested in gold, silver, Bitcoin, basically different types of scarce monies in contrast to what's happening with currency supply, and just different types of commodity producers in general. Some global equities, generally again on the value side, and then I have a kind of a decent cash position because right now we're in this period of central banks trying to push back. And so their number one goal right now is to bring down asset prices. This is something I've been identifying since the beginning of the year. And so, even I often joke that cash is the one speculative asset that I own because it's the one thing that I know is going to go down over time, that I still like to hold some in case it goes up briefly for periods of time to kind of rebalance into the things I actually want to own. And so I think it's an environment of overall defensiveness until we get some sort of pivot.
Lyn, over the past 20, 30 years, there's been a shift of labor cost difference from the US to China. What's the outcome of this in a world where lockdowns are more relevant?
So I think you brought up a good point. Basically, over the past 25 years or so, we've had this structural disinflationary force of globalization. And of course, that's actually gone back further than that, but that was the really rapid kind of China expansion phase. And I think that that's basically behind us now. That doesn't mean we go back to zero globalization. That's not going to happen. But I think that we stop globalizing probably from here and maybe even step back a few steps. And that is all generally inflationary. If you look at a chart, I like to show this a number of times. It's basically 5-year rolling broad money supply growth and 5-year rolling CPI growth. And of course, they're heavily correlated, but there are periods where we have bigger gaps than other gaps. And that's basically some sort of arbitrage or productivity increases happening. So for example, if you do that for the United Kingdom, the gap's pretty close because that was a developed country over the past 150 years that I run these charts. Whereas the United States, in the early part of that period, we had this empty continent and tons of resources, and there are also, of course, new inventions being developed. So in the late 1800s, you had a pretty big gap between money supply growth and CPI because you have so much productivity increases that were keeping prices down.
Mm-hmm.
And we had a similar gap over the past 25 years. Those are the two big gaps on that 150-year chart. And that's because even though we were expanding money supply at a reasonably rapid rate, we weren't getting a similar increase in wages because we were geographically arbitraging wages and basically tapping into this huge pool of untapped labor. Basically, the collapse of the Soviet Union, the opening up of China, these provided just, kind of multi-decade tailwinds of cheap labor to the developed world. And I think that we pretty much have tapped into that pool now. That arbitrage is in large part exhausted. And now, of course, we have this more Cold War type of dynamic. And it's hard to get, squeeze more juice out of that orange. And so I do think that going forward, that's going to be less of a disinflationary tailwind.
So Lyn, a big part of macro discussion is focused on inflation, but what's your take on potential real growth going forward?
I think overall this decade is going to be one of pretty low real growth. I mean, right now we're in a decelerating economic environment. So Q1 was poor, Q2 is pretty poor, and I think that's likely to continue for a period of time. As we stretch further than that, as we go kind of later into this decade, I think that's going to continue to be an issue. I think right now we're kind of working through so many supply side issues that that's going to impact negatively real growth. I think one of the ways to look at this is kind of looking at it as though it's an emerging market. So a lot of people are ill-equipped to deal with this in developed markets, but a lot of, I think, investors that have experience with emerging markets actually have an advantage here. Because if you look what happens in an emerging market recessionary environment or kind of a rough decade, they can have inflation, but also low real growth. And so, when you look at things in the local currency terms, often you'll see nominal GDP is doing great and stock markets are going up as measured in their currency. But when you measure them in dollar terms, for example, generally you get, it's pretty clear that you're getting stagnating or even downward growth in those markets. And I think, maybe a less extreme version, but I think that that's what we're going through in developed markets now, where it looks more like an emerging market type of environment, where you have high inflation, but low or negative real growth, because basically we're having disruptions on the supply side. You can think of real growth as more organization, more productivity. Every year we get a small amount of incremental improvement in our ability to manipulate the world around us, automate things, organize things better, technological breakthroughs. But when we encounter an environment where we've underinvested in commodities, or certain markets have been cut off from global, say we used to be this kind of one big market. If we kind of delineate a couple different markets and chop things up, and there's more frictions, we're basically taking a step back in terms of productivity. Right. And so when we do that, that's pretty much by definition not good real growth. It's harder for us to get the things we want, and that can show up in multiple ways. It used to be you go to the store and they have everything you want in any color you want, and now of course it's try buying the car you want, try buying XYZ. It's either very expensive, or it's just no matter what you're willing to pay, it's just not there, and they don't even know we don't even know the lead time. And so I think that we're kind of entering this period of less abundance, more scarcity, and just generally more utilitarian type of things, where you have to kind of focus more on necessities, less on discretionary purchases. And so I think that that's going to be a pretty challenging environment this decade.
I've noticed that also. A lot of grocery stores. I just saw an article in Germany. I mean, they're limiting people to one package of pasta, one package of flour. I mean, the scarcity is really scaring a lot of people, whether it's baby formula or diesel prices, hitting all-time highs. These things are all trickling through to the point where real people notice them every day. And a lot of people are getting scared. And don't really know how to respond to this. We've never really dealt with this in a modern America. We're so used to just having, massive numbers of choices and everything. You think this is a short-term supply hiccup, or this is a long-term built-in, this is the future?
I think it's at least a multi-year story. Yeah. I think there are avenues that we can get by this eventually. I mean, there are all sorts of manufacturing technologies, additive manufacturing. There's ways to bring abundance back in the very, very long term. But this was years and decades in the making. And I think it'll be years, at least, in the resolution. And so it's not it's not the kind of that transitory thing you hear about. But I mean, are we going to have this problem in 2040? That is when you look far enough ahead, who knows what we'll get to. But you can have very inflationary decades. And so my kind of base case is that just looking out in the 2020s, I think these problems are going to be with us for a while. But if you look far enough, that's where, any sort of future expectation gets really murky, because it's based on a number of decisions that occur between now and then. And so if we bring on new energy supplies, if we kind of, get our house in order in terms of our supply chains over time globally, I think we can get another period of real growth and more stability, but there's a lot of work to do before we get there.
But Lyn, thank you very much for joining us. It's always a pleasure to have you on. You're very popular with the audience, and we'd love to talk to you again in the next few months as this all develops this year.
Thanks for having me.
We appreciate it.
Thanks, Lyn.